Buying a home or securing a loan is one of the biggest financial steps you'll take in your life. But in today's world, some borrowers are tempted to cut corners, sometimes by inflating their income or even using fake employers to qualify for financing. If you're considering this route or have been approached with the idea of providing false information, this video is for you. Today, we're going to talk about the serious risks and consequences of using fake employment details when applying for a loan or a mortgage. Stick with me, and by the end of this video, you'll understand why taking shortcuts like this can lead to long-term problems and what safer, smarter alternatives are available if you're struggling to qualify for a loan. And as always, if you have any questions, my team is here to help. You can book a time to chat with us using the link in the description below. So let's be clear, using fake employment information to secure financing might seem like an easy way to qualify for a loan or a mortgage, but it is absolutely illegal and the consequences can be severe. A fake employer is a made-up company or entity that provides false employment verification to make you look like you qualify for a loan when in reality, you may not. The risks? You're setting yourself up for potential criminal charges like FBI criminal charges, certainly financial penalties, and even ruining your future chances of buying a home or securing credit. It's not worth the short-term gain. So how do fake employers typically operate? They'll provide fake pay stubs and W-2 forms that make it look like you earn more than you really do. They'll set up phone numbers and fake websites to confirm your employment if a lender checks. Some even go so far as to create entire business profiles online to appear legitimate. But here's the reality. Lenders are getting better at spotting these scams, and if you're caught, you could face some serious legal consequences. So the idea of using fake employment might sound appealing if you've been struggling to get approved for a loan or a mortgage, but the risks far outweigh the rewards. So let's break down what could happen if you're caught using false information in your loan application. Fraud charges. Providing false information on a loan application is considered mortgage fraud. And if you're caught, you could be charged with a crime. This could lead to hefty fines or even prison time, depending on the severity of the fraud and the laws in your area. At a minimum, your loan would be denied. So lenders have very sophisticated tools to verify employment information. And if they suspect your employment details are fake, they will deny your application. Even if you get through the initial stages, lenders often perform additional checks during underwriting and just before closing as part of quality control audits. That's when the fraud could finally be uncovered. It could absolutely damage your credit and future financing as well. So if your loan is denied to fraud, that could be reported to the credit bureaus, affecting your credit score, and this can make it much harder to get approved for future loans, credit cards, or even rent an apartment. Civil lawsuits are also a thing. So in some cases, lenders may file lawsuits against borrowers who attempted to defraud them, and that can lead to significant legal expenses, not to mention the possibility of having to repay any funds. Foreclosures and financial losses are absolutely possible as well. So if the fraud isn't actually caught initially and you actually manage to secure a loan but later default on payments, or the fraud is discovered, you could absolutely face foreclosure, and that means losing your home and any of the money that you invested into it. So the bottom line, any short-term benefits you might get from trying to use a fake employer or deceit to secure a loan are just not worth the long-term damage to your finances and your future. So lenders are on high alert for any signs of fraud, and they are required by law to verify the information that you provide. So here's what happened on the lender side when they review your application. So document verification. So lenders carefully analyze your pay stubs, W-2s, and any other employment documents. They know what real documents should look like, and they have software that flags inconsistencies. Employment checks. So many lenders go beyond the documents you provide. They'll actually contact your employer directly to verify your employment and salary. And this gets done just before closing. So if you've had a change of employment and thinking, oh, they won't find out, I'll just go ahead and close, we absolutely will find out. And if it's at the last second, that causes significant issues. So if they can't get in touch with your employer or if the details don't match, it is a red flag. Third-party verification services are also used, and that's to confirm your employment status. So these services have access to industry databases and can often detect fake employers by checking business registration information, tax records, and more. So even if the fake employer seems convincing, the chances of actually getting caught are very high, and the consequences, as we've discussed, can be severe. So if you're struggling to qualify for a loan or a mortgage, what can you do instead of trying to turn to fraudulent tactics? Here are a few safer and smarter alternatives. Improve your credit score. One of the biggest factors in qualifying for a loan is your credit score. If your credit is less than ideal, working on improving it before applying. Pay down debt, make sure your bills are paid on time, and check your credit report for any errors that could be holding you back. You should also consider other loan types. So if you're having trouble qualifying for a conventional loan, for example, maybe an FHA loan, which is a little bit more flexible, might be a better fit. So talk to a lender that you trust about the different loan types that you might qualify for with your current situation. And saving for a larger down payment. So a larger down payment can absolutely make a significant difference in whether or not you get approved for a loan. So saving up for a larger amount to put down increases your reserves, and that can reduce the risk to the lender and increase your chances of approval. Increasing your income is also a great thing to do if you're able. So if income is the issue, consider ways to boost it legitimately, whether it's asking for a raise, taking on a second job, which has timing requirements as well. Maybe it's working freelance on the side. Showing stable income, increasing income over time will put you in a better position when applying for a loan. And just remember, if you're going to have two jobs at once, just know that you'll have to have both of those jobs for a 2-year time period to count both of those income. So that's why it's important to plan early so that way you have a very clear idea of what yes looks like. Remember, honesty is the best policy. It may take longer to qualify for a loan if you have any kind of financial challenges, but cutting corners can lead to much bigger problems in the future. At the end of the day, using fake employment information to secure a loan is never worth the risk. It might seem like a quick fix, but the legal, financial, and personal consequences can last a lifetime. So instead of taking shortcuts, focus on legitimate ways to improve your finances and work with trusted professionals who can help guide you through the process. So if you're struggling to qualify for a loan or have questions about your financial situation, my team is here to help. We can work with you to explore safer options that fit your needs. You can book a time to chat with us by clicking on the link in the description below, and we will show you what yes looks like. Thanks for watching, and remember, there's always a smarter, safer way to achieve your financial goals. And if you haven't already, hit like, subscribe, and share with a friend, and we'll see you in the next video.